Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
For Max Kettner in London, it is not Thanksgiving. That has something to do with the colonies. But he joins us from HSBC. Max, you have for Global Wall Street a killer sentence in your note, which is a spectacular mystery about Q4 earnings, revenues, and cash flows. How in the dark are we when we get to earnings the middle of January?
Yeah, look, I think, and thanks for having me. Good morning. Look, I think on the Q4 reporting season, what has been remarkable, in fact, in the last couple of weeks is how much those earnings expectations have actually been slashed even further. We already had almost expectations only about flat Q4 versus Q3 at the end of the third quarter reporting season. That now has all but changed in November, where now consensus is actually looking for a sequential drop in earnings from Q4 to Q3. Now, of course, you could say that makes sense because of the government shutdown and all that, but I do question how much a government shutdown really is related to the largest caps. Let's remember, when you look at the S&P, we're not really buying 500 stocks, right? Look at the first 20 stocks in the S&P. That's half of market cap. I do wonder really if people haven't got a little bit ahead of themselves in terms of reducing their expectations.
Max, the Max Kettner hallmark, folks, is to be in the market. He has been dead on easily over 3 years of saying you've got to participate, you got to be in the market. Lo and behold, earnings show up better than good. Is that going to be the same sequence this time, Max?
I think so. And I think actually it's a continuation. Already in the second quarter, we've seen that. You know, remember second quarter, it was the first sort of earnings season where people were really worried that tariffs would show up. Whereas in fact, what happened was that even the 493 stocks outside of the Magnificent Seven, the earnings expectations back then were 2.5%. And the actual earnings were almost 9% year over year. So they were really crushing estimates. And we've had a similar sort of beat rate now and a similar sort of earnings surprise in the broader market as well. Now in the third quarter reporting season. And now when we look ahead in the fourth quarter reporting season, what I find remarkable is that we're going to get basically consensus saying that 8 out of the 11 S&P sectors are seeing a sequential drop in earnings. And with such a bearish backdrop, with such low earnings expectations, it's not even, we shouldn't even be calling it a hurdle or a bar to beat. It's literally, you just walk over that. That's how low the bar really is, right?
Hey, Max, you're the chief multi-asset strategist for HSBC. What asset do you like, and where in the world do you like that asset?
Yeah, we can't really be much more bullish, to be honest. We can be a tiny bit more, but in reality, we're almost full on conviction, full on long equities. So we're almost maximum overweight in equities, particularly in the US. So really like the tech side of things, still the AI capex story. I think people are really throwing in the towel a little bit too soon on that, but also rotating a little bit into the cyclicals, right? Going with the industrials, perhaps, you know, with some of the more cyclical part of the market, because I think people do underestimate how strong actually underlying fundamentals are, especially going into next year with those really, really positive effects for next year's growth through the big, beautiful bill for capex, but also with the tax reimbursements for consumers. That should be also perhaps leading to a little bit more of a cyclical uptick than consensus is currently expecting.
On this Friday, a special edition of Bloomberg Surveillance will be with you through the 10 o'clock hour. Paul Sweeney and Ivani Quinn moving forward to 12 noon. There is trading, as Paul mentions, market, stocks closing at 1 p.m., bonds closing at 2 p.m. But we welcome you around the world as we try to have good conversation today to summarize where we are for the dash to the 2026 with Max Kettner, our Paul Sweeney.
Max, I can sit here in a U.S. 2-year Treasury bond and get 3.5%, which is not a bad way to make a living. Are you taking credit risk above and beyond kind of what you can get in just the U.S. Treasuries?
Yeah, I am. We're still long high yield. We've been a bit more long really over the years, so we've sort of tempered our enthusiasm, shifted more towards equities rather than preferring credit. So really preferring equities over credit. But the overall technical picture for credit, whether that is in the US or in Europe, really looks very, very strong. When we think about the improved index quality now, the improved average index credit quality, when we think about the maturity wall for next year, the maturity wall both in US high yield and in Euro high yield is much, much lower compared to what it was at the beginning of this year or last year. So with such a strong technical backdrop, I do think it's going to be tough, really, to actually see credit spreads widening materially. And then, it's just a game of harvesting carry and a game of really sort of picking up the pennies in front of the steamroller. But there is very little, at least in the next sort of 2-3 months, that really should be in the way for credit spreads to widen materially.
Hey, Max, we got the U.S. dollar it sold off earlier this year with all the, I guess, the tariff, news in the beginning of the year. But since kind of recovered a little bit here, how do you think about the currency markets? Where do you see value out there?
Yeah, I think, look, when we look at FX, I mean, it's amazing, the whole dollar debasement story and the story around the end of the dollar as a reserve currency. And in fact, you look at the last 6 months, the number one thing that's really happened in the FX and the currency space has been that volatility has crushed. So in reality, when you say, where's value there? It's like, well, you can sort of short the 100 in DXY and then at 97, 98, it's not really that attractive to be selling the dollar anymore. So there's no real conviction on the dollar, right? The dollar largely trading sideways. What that means is going for the higher beta, higher carry currencies and the higher beta, higher currency duration plays and rates. So think like the likes of Brazil front end or Mexico or South Africa, really playing the sort of the short vol theme that is still dominating in FX. That's really still coming from the sort of very subdued front end trading in the US. Max,
you're underselling yourself. Folks, HSBC, more than anybody you know, was out front on strong dollar. A guy named David Bloom, I don't think Max could shave then, but they were way out front on strong dollar ages ago and absolutely nailed that call. Max, I want your view on the true madness of Mag 7. You're in London, you're removed, you would know Oracle if it hit you over the head, or all the rest of them. Max Kettner on an enduring Mag 7. Will they have a good year next year?
I do think so, particularly in the next sort of 6 months. I really think that people are underestimating perhaps the ability of CapEx in the AI space once again to surprise to the upside versus consensus expectations, particularly given those incentives, those CapEx incentives in the One Big Beautiful Bill. And I think, if we're looking from 26 to 27, that might be a different story. Perhaps what we're doing now is that we're effectively pulling growth forward from 2027 to before the midterms. Sure, fine. But that means that perhaps then a story for this time next year, where perhaps we might have to be a little bit more cautious on the Magnificent Seven, but particularly for the next 1 or 2 quarters. I think particularly on the CapEx story in the AI space, I think people are still underestimating the ability of those companies to surprise to the upside.
The Hong Kong and Shanghai Banking Corporation, Max Kettner, where are you on what we've seen with Chinese equities this year? Does that endure? Do you see China with their exceptional politics in Beijing shifting to some amendment that allows for better markets?
Yeah, I do still see actually value in Chinese equities, particularly China tech, whether that's onshore or offshore, because when we look at other markets, so if you're building a global portfolio like ourselves, if you have a global asset allocation and you're saying, well, you know what, I don't want to just buy Magnificent Seven, I don't want to buy just the US AI story, I want to diversify away, perhaps within the AI space, but at least diversify away a little bit. Well, the problem is if you go in some of the other Asia tech names, you're really staying within the same supply chain. So the issue is you're sort of buying the same stuff. Whereas with China tech, it is truly the different supply chain there. And there is really, apart from the earnings potential, the much lower valuation, which of course are attractive. But to me, the main real positive on the China equity space right now is particularly the tech side that gives you a genuine only space of AI diversification, and particularly in regional terms right now.
Right. And Max, interesting. Okay, folks, I want to give you a window into Bloomberg Surveillance, a special edition today, June 23rd, 2016.
Oh, boy.
Okay, young John Farrow, because he has a British accent, has been told in London that he's on air for like 15 hours. They take the American accent and they take me off air. I have nothing to do, so I called up Max Kettner and I said, Max, where do I get a decent dinner? So Max sends me to Brown's. It's in Mayfair. It's like wicked old school. Max, here's the Thanksgiving dinner at Brown's yesterday. The free-range Norfolk bronze turkey, sourced from Downlands Estate Maple Ranch. It's a sustainable farm. And with that, they've got the pecan and gingerbread pie and the pumpkin creme brulee. Max, did you celebrate an American Thanksgiving in London yesterday?
Sadly not. It's not got to do with inflation, but of course, I mean, all I would do is eat schnitzels every day because I need to adhere to my Bavarian self, of course.
I could see that. I'm looking at what Claridge's did. Are you kidding me? They got Dante in from New York City, and I mean, they're doing Thanksgiving big over in Max Kettner's London.
I know. It's big. Tim Craighead had a big crew.
Look at this. I think Lisa started with Michael Barr. I think Lisa started with this at 3 a.m. The spiced cranberry spritz featuring Perrier-Jouet champagne Aperol. How was that, Lisa?
It's still good.
It's still good. It keeps on ticking. Max Kettner, you're a trooper to be with us here on this special day for America. Mr. Kettner is with HSBC. I can't say enough about he has said participate in the market. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
He's the former chairman and CEO of Saks, but so much more. He has lived across the generations, folks. The retail we have all done with our 70% of American consumption, affiliated as a senior advisor at MasterCard. And years ago, the young Sadove with Kraft. I mean, Steve, when you advanced up into the pantheon executives, they gave you the Jell-O brand. Now, Jell-O's on a roll right now. They're doing a retrospective thing on the Jell-O where you can buy like a Jell-O mold that's the shape of the Ocean Spray cranberry can.
Really? Okay.
Where do these ideas come from, Steve? If you're in a room at Kraft decades ago, is it like 7 young whippersnappers and you sitting around a table going, how can we goose Jell-O brand?
Well, Tom, first of all, it's great to talk to you, and you have such wisdom on so many topics, and I love talking to you about retail. Go back to my Jell-O days, and you had some of that sitting around in a room, but you also had people. I remember one of the great recipe innovation ideas we had was Jell-O Jigglers, which was handheld Jell-O. And it essentially doubled the size of the business because you had to use 2 packets instead of 1 pack to make handheld Jell-O. So. And the idea came out of somebody in our test kitchen found it in a recipe book that had been sitting around, and the recipe had been developed years and years earlier. So ideas can come from anyone. And I think part of the role of leadership is finding, getting people to go look for all these great ideas. I found when I ran Bristol Myers, the consumer businesses, and we created Herbal Essence shampoo. That was the same thing. The ideas were kicking around. So
that's great.
I find, that's to me, even in retail, it's all about ideas. And that's what we got to focus on.
Steve Sadove, what would you do with Gucci?
Oh, my gosh. First of all, Gucci is a great brand. I think that they need to come back and, they had a wonderful run for a long time. I think that they went a little bit too far fashion forward. I think that it's all about getting the right designer, the right fashion trends. I think it'll come back. I think that the prices on a lot of these brands have gotten out of whack. And I think that it becomes a question of, do you have the mix of the right innovation and the right price points? And I look at any number of these brands. Gucci's just one. I look at the resurrection you're going through with Burberry right now, and you lost sight of who the brand was, and the prices got too high. And they're doing a really good job of sort of getting back to basics. And I think Gucci needs to do the same thing.
Steve, we're getting right into the teeth of the holiday shopping season right here. What are some of the big, trends, opportunities? What are the big themes for retailers these days?
Well, look, I think you got to start at a macro level and say, where is the consumer and what's going on? And you've heard a lot about this K-shaped economy, and it's real. The high-end consumer is healthy, the very high-end consumer. They're tied to the market. When Tom and I used to talk about this when I ran Saks, I would say there was a 0.9 R-square between the stock market and the high-end consumer. So the very high-end consumer is healthy. But the aspirational luxury consumer is struggling, and that's why you see luxury in aggregate not doing quite as well, largely because a lot of it was driven by the aspirational luxury customer. And the lower end consumer is really stretched. And you see that $100,000 consumer trading down to Walmart, and that consumer is finding value. They're looking for innovation and value, but I think that the lower end is really having a hard time. People aren't as secure in their jobs. They haven't lost their jobs, but and their wages are okay, but they're really stretched and being affected by some of this inflation and tariffs. So I think that the overall trend is value. I think it's about innovation. Luxury is getting its footing back. I think you've stabilized and starting to see growth in luxury, but you lost that value equation at the high end because the prices just got, a typical Chanel bag, when I was running it, it's probably 2 to 3 times the price for the same item that it was when I was running the business. So the prices have gotten a little bit out of whack.
Steve, when we talk about luxury, a big part of it and a big variable is China, the Chinese consumer here. How do you guys, if you were running Saks again, how would you think about the Chinese consumer these days?
Well, if I was running Saks, we were largely a domestic business, so I didn't have to worry as much about the Chinese consumer. But clearly, the Chinese consumer is an important, that and the U.S. consumer are the biggest luxury consumers in the world. And the Chinese consumer, I think their high end has been stretched also. That consumer is gone a lot more domestic than they had been. One of the things that you deal with the Chinese consumers, they know very much what the global pricing is on all of the varying brands, and they travel enormously. So they would go where the best pricing was. I wouldn't count the Chinese consumer. You have this vast growing middle class, and the aspirational luxury consumer is still there. So I wouldn't count the Chinese consumer out.
Steve, the heart of the matter is Lisa Mateo needs a new pair of shoes, and the destination with its own zip code is Saks Fifth Avenue, the shoe department. Have you been there? It's the size of Rhode Island. Yeah. What was it like inventing that, Steve Sadove?
Oh my gosh, this was one of the most fun things. And we, my head of marketing, Terrence Schaefer, who's passed away, he was a great guy. We came up with this idea that we wanted to fundamentally change the way shoes are shopped in luxury, and you needed to have a lot more space. We had the shoe floor, I think it was on the 4th floor or 5th floor in the New York store, and we wanted to move it up to the 8th floor and give it its own floor. Yeah. We came up with the idea of giving it its own zip code, and most houses have a suffix, a 4-digit suffix at the end of their zip code. I have no idea what mine is. And we went to the post office and said, can we have a suffix? And the post office said, no one's ever asked for one before. Well, we said, we want shoe. And our zip code was 10022. And they said, okay. So we became 10022 shoe, the shoe floor that was so big it had its own zip code. And that concept took off. The shoe floor essentially doubled these sales of shoes. And that became the forerunner for every luxury retailer in the world, going off after creating bigger and bigger shoe floors, because shoes The two big things that people, women luxury shoes and handbags were the two drivers of the business. And oh my God, obviously apparel is important, but the shoes and the handbags made the business, and that became the destination in the world for high-end shoes.
I can't say enough about the stories, the expertise, and the present tense wisdom of what's going on with Retail America. Stephen Sadove is the former chairman, CEO of Saks, and of course, senior advisor to MasterCard as well. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We fall back on good conversation with Jeffrey Roach, chief economist, LPL Financial. And he's got a really twisted note. I mean, it's just a whole different take on what's out there. And you go, Jeffrey, to something that's percolating with our guests, which is a set of tailwinds helping us into 2026. Describe the major tailwind that advantages us for next year.
Well, good morning. Thank you for having me. And it is somewhat unusual. So the more normal components, clearly when the Fed is easing and there's no recession risks, at least no heightened recession risks, that's typically pretty good. And then the second one that everyone's talking about is the OBBBA tailwinds. But I think there's a couple things, two factors that perhaps may not be major key players, but certainly something to think about. We are hosting World Cup matches. That's certainly going to do a little bit of a boost on spending. And then the semi-quincentennial celebrations. And I think that's something that, again, somewhat unusual. Perhaps it's pushing the cycle out a little bit longer. But those two non-consensus additions, certainly important to put in the back of the hopper here.
And Jeffrey, how do you view the U.S. consumer here? We have this K-shaped economy, but you put it all together, and on an average, it seems like the consumer's doing okay out there.
Well, I think the bigger question is, have we always lived with somewhat of a K-shaped economy? That certainly happened. I remember, I started my career just before the GFC. And so you think about perhaps just it's a more pronounced K this time around, but we've always had it. And I do think that does continue into 2026. You do have the upper income, the more affluent households doing fairly well. And there's not much a pullback there yet. It seems like that's going to continue into 2026. And then, of course, the headwinds for the middle and lower income. K-shape will continue, I think.
Jeffrey Roach, is nominal GDP linked to free cash flow and growth of free cash flow? Or are we in such an odd place you can't link the two?
Well, that's a good question on the nominal versus the real dynamics. I think one of the biggest challenges fundamentally, I think before you get to that question, fundamentally you say, are we even measuring the inflation component correctly? Yeah. And then, of course, with the hit to the BLS and BEA staff trying to measure inflation, I think we've had a real challenge since COVID. So I don't know if people have a good handle on the dynamics between how nominal is relative to the economy. It is quite a distorted economy. I think you just continue to listen to what the businesses are saying. I think that's one of the reasons why I think Beige Book continues to be very, very important for policymakers, because some of these more official metrics are a little bit distorted.
Jeffrey, given that background, what do you think the Fed should do or will do in the upcoming meetings?
Well, I think the should and the would are actually getting a little bit closer. I do think that they're going to focus on the weakness in the labor market. We've certainly seen a lot more announcements on layoffs. Now, granted, we haven't seen that show up in the weekly claims numbers, and that's the reason why we have so much debate going on. But I think there is going to be a focus on the weakness in the labor market. There will be a cut in December. Now, granted, if they don't do it in December, then it's just pushed to the next meeting. I think the bigger picture for markets is what is the trajectory for 2026 going into 2027. I do think they stay on that rate cutting campaign throughout the year. And again, this is good for risk assets. If we avoid recession and Fed eases, that's typically a good recipe.
So, Jeffrey, for 2026, how do you think this one big beautiful bill will impact the economy? I mean,
That's the key question.
Yeah, a lot of folks are calling that out as a tailwind.
Well, I think we're going to see a little bit, perhaps a little bit more clarity, perhaps in Q2. I think Q1, I do forecast that that's going to be a little bit of hit in growth, but I think it's going to be this push-pull here. You have perhaps this risk that consumers will get much larger returns than expected. That's going to provide a boost to spending. I don't know what businesses are going to do in terms of passing along these tariff prices to the end consumer. That's the real uncertainty here in Q1. What's going to happen with inflation? Are we going to see inflation have another bit of an uptick like we did in August, September?
Right. This has been wonderful. Jeffrey Roach, thank you so much. Really appreciate it on this special edition of Bloomberg Surveillance. Mr. Roach, Chief Economist, LPL Financial. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Jordan Rochester's been on airplanes. He's back in London now. He's had a FICC strategy for EMEA at Mizuho, just doing a fabulous job there, summing off of Steve Rasciuto and Dominic at Custom. Jordan, I want to go beyond the London thing. We did it. It's not that it's old news, but I think what people want to know from you is the framework of a resilient U.S. dollar. Will that sustain into 2026?
Good morning, everybody, and happy Thanksgiving for those who I didn't speak to yesterday. Well, yes, I think in the short term, Tom, the setup is quite good for the dollar right now. Part of that, despite lower US yields, is because of the US exceptionalism creeping back into the equity market, where in the European space, those equity trades that have done very well this year, such as defense and banks, are looking a little bit more tired. But really, it's about the fact that we've got a lot of positioning that has already been short the dollar for most of this year, especially since Liberation Day. Right. And the momentum in euro dollar has completely flatlined. If you look at volatilities in terms of the FX volatilities, you've got realized volatility on a 3 handle. I know it's a bit complicated, but that is just not something that is very high at all. It's extremely low volatility. So I think you're seeing people take profit on the trades that were profitable this year, which was long the euro, short the dollar. And you're seeing a little bit of that feedback through into dollar strength.
So into next year, I'll take this question where you want, Jordan. What we're looking for is big figure moves. Do you see big figure moves in weak euro or weak sterling this year?
I think you'll see it. In terms of the next month, we're currently short the euro, long the dollar. I'm looking for 114.50, which is at least a big figure from where we are now. That's something of more of a tactical trade. I think what will happen is the Federal Reserve will cut rates in December, but it's going to be a hawkish cut. I think Chair Powell's going to buy himself some optionality for the first few meetings of next year because of the sort of tussle that's taking place between Fed members worried about inflation and those worried about the labor markets. But I am worried, Tom, that actually what could happen next year is the labor markets just really collapse. And we're starting to see negative ADP figures on the weekly basis. Next week, we get the monthly version of that. If the private payroll continues to have negative sort of job losses, then perhaps actually we're going to see much bigger moves in rates and FX than what the current market pricing is.
You know, Paul, Joe Weisenthal has a band called Light Sweet Crude.
Yep.
Doing if I had a band if I put a band together, do you know what I'd call it?
What?
Hawkish cut.
Hawkish cut.
That would
There
be
you
the
go.
name of the band.
So, Jordan, I mean, our Fed, I'm looking at the work function here, Jordan, and it looks like a 80% chance for a rate cut in December. How do you think the cadence will be with this U.S. Federal Reserve and any future rate cuts in 2026?
Indeed, it's a bit tricky for them because they don't have much data before the next meeting. A lot of private data, but non-farm payrolls and CPI is what they're kind of lacking. So we're going into that December meeting where I think the tee up for that is they told us in the dot plot they were going to do one more rate cut this year. They told us that in September. They then repeated in October that the outlook hasn't changed. So I don't think the outlook has materially changed for them to skip the December meeting. That was a non-consensus view just 2 weeks ago. So I've just got to make that clear. Then for January and onwards, the key point will be we'll start to get inflation coming back into, we'll actually get the releases. And do we see the tariff impact actually accelerate? It seems to me that the answer is not as much as feared. So I'm not that actually worried about tariffs feeding through to stronger inflation. But if I'm wrong about that, that could really see the market reprice what's put in for January. Then the labor market. Is this youth unemployment spike that we're getting, is that just a temporary phenomenon or is that an AI structural story? If that carries on, then maybe January is more of a live meeting than I give it credit for. But I'm not worried about growth whatsoever. I think that you've got fiscal stimulus from the US, Europe, Japan, and elsewhere. Combined with Fed cuts. So you're going to have a pretty good Q1 and Q2. Throw on top of that the AI capex, which I don't think is going to roll over. The Fed's torn. Good growth, mild inflation, too close to 3, but a weakening labor market. I think it's like no cycle we've ever seen. So they just need time. And I think they might skip January and March.
Paul, you brought this up earlier. This is like the balloon over MetLife Stadium for the Jets game. There's stimulus coming. We are not factoring in the stimulus that we're going to see from President Trump's legislation.
We'll see if that comes to fruition in 2026. George, give us a sense of how the UK economy is. I know the OBR leaked the numbers on the budget last week. Just give us a sense of how the economy is in the UK.
Well, it's had sticky inflation thanks to administered prices, which is the Chancellor's reckoning of the last budget where she raised taxes. So we've had a mixture of higher taxes from last year's budget lead to higher than expected inflation this year. But it wasn't just the Chancellor's decisions. It was also food and other items that came through more hot. So the Bank of England's been torn between growth that has been quite sluggish, around 1% or so, and not really screaming that you need to be a hawkish here. And then the labour market data has been very much on the weak side. So similar, less optimistic than the US. So growth is middling around 1%. And I actually see downside risks to growth myself. Inflation has been much higher than we'd like to have seen. But we've now seen the peak of inflation. We've gone past the hump, essentially. And from here, it's all about how quickly will inflation fall. I see inflation falling quite quickly to a 2% handle, possibly by the second quarter of next year. And that's by the OBR's own sort of reckoning as well. Why is that? It's because the Chancellor learnt her lessons and instead she introduced measures at this budget to knock off 0.3% from UK inflation. Then there's the housing market, which in the UK drives everything. Just think about it. When you buy a house, you get new carpets, a new sofa, a new TV, and you might even hang up the curtains. Well, the housing market's really, in some respects, in free fall. It depends what chart you're looking at. Transactions near record lows. We're seeing even the rental market slow down significantly. I think that's because of immigration. Tighter rules around visas. So net immigration has also really dropped in the UK. And we're seeing tenants really not in the surveys, not showing up in the demand space. And landlords are lowering their rents as well. So you've got a combination of tax cuts, slower housing market, middling growth, and negative base effects. It makes it quite easy for the Bank of England to cut rates.
Combining your work with Rashudo and Constant on the tariffs, Paul and I, Jordan, are surprised how the tariff discussion has walked away through November. Are we over the tariffs, or is that going to revisit in January?
I think, well, in terms of, you make a good point here about timing, because the Supreme Court decision is probably coming soon. It might even be in December. So if the tariffs are repaid, then the market will like to see that, and you'll see importers receiving possibly around $45 billion in receipts back to them because the IEEPA is therefore not allowed to be used. But the White House has the ability to raise Section 301, 232 investigations, which they're already doing. They've definitely prepared themselves for this eventuality. So it's not the end of tariffs. But bigger picture, what we've really seen is the amount of money coming in for tariffs is about half what it should have been, which suggests that importers are finding a way to lower their prices and pay half the amount that they should have on the tariffs. And I think there are clever ways of doing that, where if you're a Chinese company and you set up in the US and export to yourself, there are ways around it. And it's called importer of record before you then sell on to the US final consumer. That's what the data says. We're roughly getting an effective tariff rate of 9.5% versus what we calculated and the rest of the market. It should have been closer to 18%. That means the inflation impact has been half the amount. Plus, you've got the ability for tariffs to maybe be rolled back by the Supreme Court. Tom, in answer to your question, I'm not too worried about tariffs pushing up inflation.
And Paul, this is critical. The budget lab at Yale is near a 9% level as well. Normal for us growing up was 2 to 3%.
Right.
So it's still really elevated. I mean, the president, Lisa, help me here. The president's taking away the tariff on bananas?
On bananas.
I think so.
That's good.
What about coffee?
In the banana aisle at Costco.
Yeah.
Get a couple more in here with Jordan.
And the hot dog and sodas are still there.
Can you imagine
Costco.
working with Dominic Constant and Steve Rasciuto every day?
No, thanks. No, thank you.
It's just extraordinary.
Tough. Jordan, so in terms of the currencies out there, what's the best value as you think about 2026?
Let me rephrase this. What's the best trade? Because Paul and I lost money on the Detroit Lions.
Well, look, we're currently short the euro, long the dollar. That's the sort of FX trade we like. In terms of rates, we're much more dovish on the UK. So we're doing lots of front-end flatteners. We're doing lots of received positions in the UK. We just bought gilts. Despite the big rally, I think that can go further. In terms of the front end for the Bank of England, we look for them to get to 3%. High conviction views are in the UK curve. For the US, we're doing Z5, Z6 flatteners. I do think this market...
Whoa. In the US, you're doing what?
Okay, so what we're doing is we're expecting the rates in the US to continue to hover around 3% for the next year or so, which is where it's currently priced. The new Fed chair means the market will constantly think that the new Fed chair will be dovish. Therefore, it's hard for that market to sell off. But in FX, the yen's the one that screams cheap. We haven't got it on as a trade. We're not currently short dollar yen. I actually think the risks are it goes even higher than where we are currently because the BOJ needs to act. They need to do a rate hike. They've been delaying. We're now thinking December might happen, but it's now over 50% priced. So I actually think the Bank of Japan might disappoint us on December, and dollar yen has another leg higher.
This is delicate, folks, with Mizuho. When it finally goes, Jordan Rochester, what will be the magnitude of a yen strengthening from 156, 157? What size do you see there?
We've got 140 down to 135. Wow. If the Fed new chair goes ahead and cuts rates, and we talk about a 2% terminal. And that's if the Bank of Japan raises rates twice next year, which is not fully priced. At the moment, that isn't a high conviction view, so we're not yet trading it. But that's where we could see a big move next year.
That's fine. That's 15 big figure move, folks. That gets your attention as well. Jordan, thank you so much for joining us on this special edition of Bloomberg Surveillance. Mr. Rochester in London is with Mizuho.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.